Dave, how are you doing today?
I'm doing great, Ryan. How about yourself?
Doing good. I am really excited for this because the small world that has continuously gotten smaller over the last 6 months as we got to know each other through my partner Pat Hobby and some of the things that you've done together. And then I had interviewed Jack Stack on the show about a month ago, and I saw that you guys are sponsoring his new conference or his conference this year. So and then some of my college buddies that work at Belay here have worked with you. So here we are. So for the listeners, because Dave, I've talked about ESOPs quite a few times, had people with stories on them, and then we've done a couple little, some deep, some surface dives in them. But then you guys have a very unique setup at Prairie. But before we kind of go into some of the meat of this, maybe just give us a little bit of a background of like how the heck did you get to where you are today and what you're doing?
Sure, no, absolutely. Our business was started 23 years ago by two of my partners, Ken Serwinski and Bob Gross. They headed up the middle market merger and acquisition and ESOP practice within Merrill Lynch. Merrill decided to they wanted to move upstream with some of the size companies they were working with, and Ken and Bob really liked working within the middle market. So they split off and started Prairie Capital and really doing the same thing that they were doing there, which is really focusing on ownership transition, helping individual and privately held business owners, make decisions on how to exit their business, and then even more importantly, how to go about executing that. And really, that's where our business is today. So our process really is about educating the sellers and helping them to understand all of their exit alternatives to vet, what the best alternative is. Because while most business owners are fantastic at running their companies, they make a great widget or they provide a great service. When it comes down to exiting their business, they probably only do this once. I mean, certainly there's some serial entrepreneurs out there who have multiple exits, but most of the entrepreneurial business owners that we know are going through this one time. And so, they have a limited knowledge of what the whole process is about and what alternatives they have, and to some degree, what it means to them both from a tax standpoint, a financial standpoint, and also an emotional standpoint. Our goal is to help them to navigate those waters and to put themselves in a position where there's, they have, at the end of the day, when they end up selling their business, they have put themselves in a position where there's no remorse, where they have full confidence in what they're doing and how they proceed. So what we do is really vet, all those alternatives. And there's not a whole lot of companies that really practice the way that we do, but we have traditional investment banking practices where we, merger and acquisition advisory, where we're selling companies to third parties, whether that be strategic or financial buyers. We also will help with management buyouts and structuring, effectuating management buyouts or recapitalizations, family transfers. But one of the things that we're going to talk about today is also we have an expertise in the ESOP arena, which is a little different avenue that not a whole lot of people have heard about, but not a whole lot of people have a deep understanding of as an exit alternative. And that's really it's a government-sponsored retirement plan that allows for exit from privately held business. So we'll probably get into that in a little bit here. But
before we do, what led you to this? Like, what were you doing before Prairie? I mean, have you always been in finance, or what was your business background? Because you got a lot of passion behind this, and I think that's one of the things that is necessary to fuel people in our space.
No, absolutely. So I worked for a bank, actually in the wealth management group. So I was working with families that had 100 million or more in liquid net worth, helping to advise them and administer their assets. While I was there, the one thing that most of these people were obviously entrepreneurs to build that sort of wealth. They'd been very successful. They were still hiring good people, but what I saw there and what I realized that I needed when I was going to grad school at the same time. So while I was going through that process, I realized that I really wanted to work in a transaction environment, and I wanted to advise people. When it was, in this case, like true advice. I mean, there's a lot of times when someone knows a good amount about a product or a process, and you're there to be able to facilitate the sale of a product or a service offering that is well known, but you're one of many that provides that service. I really wanted to get into a consultative scenario where I was able to to provide advice to people who really had need and were needing expertise and needing people that they could trust to effectuate the transaction. So the transaction side really attracted me, and there was nothing like that actually at the bank that I was at. But I did interview up and down Wall Street coming out of grad school, and that seemed a little bit more I mean, it was all public company work and whatnot. While it's obviously very important and good intellectual work, it was lacking some of the the educational component and the emotional component that I really was striving for. I thought I want to try and make a difference, and I met Ken and Bob, and they're out here advising these privately held business owners who really need help, and they need someone that they can trust. And I thought they seemed like a couple of good fellows, and I joined them, and it proved to be an excellent decision, because I really enjoyed our path and the growth of Prairie Capital, which when I joined, I was employee number 7, and now we've got 8 offices across the country, and we're about 53 people right now. So
it's super cool. And as you know, for the listeners here, I mean, as we've started kind of doing some work together and collaborating on clients, I mean, there's not a whole lot of, there's sometimes you find an investment banker where they only get paid to sell your company, right? So they're not going to sit down and actually help you, tear through the different options, right? I mean, so that's why I think that what you guys are doing and how kind of your suite and spectrum of services is important for, as we're bringing you involved. It's like, hey, we actually can put some meat on this as far as the different options, because you kind of don't care, right? You're just trying to get them to the right equation that makes sense for them, and it doesn't happen too often. Was that complicated at the beginning as you guys were trying to figure out how to pay the bills? I mean, like, how did you guys start doing all the services right off the bat, or was it you slowly started adding them, and like how did the whole thing evolve?
Well, so obviously it started pretty small, but because of our ESOP expertise, on top of the pure investment banking, what that did is that provided some annuitized revenue. So, we actually had done some work in the ESOP space, and there's a requirement to have valuations done annually within that environment. So while the M&A space is it's all transaction related fees, where you either sell the company or you don't, and you either get paid or you don't. That's a very volatile structure.
Yeah.
Our structure really gave us a lot of balance, because we ended up building a nice recurring revenue base that provided us with the protection we needed to keep the lights on, and made the rest of it purely additive. So as we've continued to grow, we've never had to lay anyone off since I've been at Prairie Capital, and we continue to add on additional work and services. And part of what's allowed us to do that is this structure, because we can be extremely patient with sellers. This isn't something where we need to get a deal closed in any given year. We want to do right by the clients, and being 55 people who cover the country with these services, we need to have happy clients that are out speaking about our services and the job that we did to their other entrepreneurial friends, and helping us to expand the message. Not only them, but also the other professionals that are in on the deal. So by being patient, we also are not, we're not pushy in scenarios, and certainly, bankers, lawyers, accountants, wealth managers, are excited to bring us in to meet their clients, because again, we can do some education without them having to feel that someone's going to be sold, hard on signing up for services or whatnot.
No, I think that's super important, because I mean, like, I was just talking last week to an attorney where, like, I mean, sometimes you just like if professionals just have to get the deal done, but it might not be the right situation, right? I mean, just based on the kind of the infrastructure that each advisor brings to the table. So I think it's important, and I know we're gonna. So kind of for the next 45 minutes, I want to kind of maybe take this in chunks, because you guys are one of the leading ESOP specialists in the country. And then, so like I said, I've done some various episodes about this, but I think you guys I want to kind of dive into that, but then also kind of comparing the ESOP structure then to financial buyers and private equity, and kind of the state of the market. But Dave, let's just kind of start with the ESOPs, and just maybe in your general layman's terms, like, what are they, and then how long has it been around, and kind of just give us the kind of the crash overview of it.
Sure. No, so the ESOPs have been around, whether they're technically ESOPs or not, for quite some time. But really, in the 70s was the first creation of the ESOP. What an ESOP is, it's a employee stock ownership plan. This is a ERISA-sponsored retirement plan that the government has put in place that helps to for an owner to sell their stock to their employees in a tax-advantaged manner. So the really relative to a management buyout, it's not dissimilar. But the main difference is that it's a tax-advantaged management buyout. with the primary difference being the tax advantages, but also the fact that there is, in a lot of management buyouts, it may be 2 or 3 managers who are buying the whole company. With an ESOP, anyone who's a full-time employee will participate within the plan. So, it's non-discriminating, broad-based dissemination of wealth within the company. So, from that standpoint, it's a great tool, to help to provide additional compensation, to all employees, and ideally to tie their performance to some of their compensation, because if obviously they collectively perform well, share price goes up and they all increase their wealth.
Which I want to kind of we can kind of take these in chunks too, because like understanding how that actually buyout happens, because you'll maybe get a kick out of this. I was doing a presentation to a bunch of owners, and we were talking about the various exit options, and they said, well, I didn't know an ESOP was an exit option. You know what I mean? Like they thought they were just going to give their company to their employees. So, I think there's just, and that's kind of the whole point of us doing this stuff together, right? Is like continuously, educate people on that. So maybe just kind of walk through the whole process of how an ESOP, I mean, you do these all the time. So whatever way you think that the listeners will be able to digest this in a meaningful way, of how does the whole process work, and how does the seller walk away, and what's the kind of the situation after the fact?
Sure. So, within an ESOP, just from a pure technical standpoint, an ESOP needs to be formed, which is basically a trust that will end up being the purchaser of stock. And again, it's an ERISA protected retirement plan that's established within that trust. In this case, a seller would look at facilitating something like this. How the seller would get paid is that the company, would go and borrow money from the bank. So you're using the balance sheet of the company to go and borrow funds. The company then lends these funds to the ESOP, and the ESOP uses those funds to buy stock. So, as far as the flow of money is concerned in this regard, that's how the flow of money goes. And in fact, the seller may in fact provide some seller financing to the company to help to facilitate some of that buyout as well. But the money travels from the bank through the company, is loaned to the trust, and then goes to the sellers. Now, what this does is basically it allows for this tax savings that we were talking about. So in a normal management buyout, you're looking at a company that goes and borrows money in a similar fashion. You're borrowing off the company's own balance sheet, and the company needs to pay back that debt. Well, after you pay taxes on profits, you have free cash flow that you have the ability to pay debt on. Obviously, the interest you can pay on a pre-tax basis, but the principal you cannot. With an ESOP, effectively, if you do a $10 million transaction, you're going to have $10 million worth of tax deductions that you're going to be able to take, on that purchase, which is going to basically make the repayment to the bank pre-tax in nature. Mm-hmm. So there's a real cash flow advantage to using an ESOP. Now that works whether you sell, 10%, of the company to the ESOP, or you sell 100% of the company to an ESOP. That deduction is available. The holy grail on that front, though, is when a company is 100% ESOP-owned S corporation. An S corporation is a conduit tax entity. So for those that own S corporations, that every year the company makes profit. You receive, the allocation of the profit is actually distributed and recognized at the individual shareholder level, and the shareholder has the requirement to pay tax on the income that they've received through that pass-through entity. Well, an ESOP is a tax-exempt entity. So in this case, an ESOP is passing, a company that's 100% ESOP owned is making that profit at the corporate level, but there is no tax obligation to its shareholder because its shareholder is actually a tax-exempt entity. So the company is able to
vehicle, right?
Yeah, so the company is able to retain all that cash flow to greatly accelerate its pay down of the debt associated with the transaction. So really powerful tool in that regard.
Well, can we, and let's, because I know we want to keep going to it, but like just to kind of maybe reiterate and clarify some stuff for the listeners, so let's say maybe we take a couple examples of numbers, Dave, where like, let's say we've got $1 million, and maybe before we do this, what is the general qualifications of an ESOP as far as like the minimum for employees and cash flow? And then we can kind of put an example on it.
Yeah, I would say in general, companies need to have about 20 or more employees, probably 250,000 in EBITDA to do an ESOP. Now you can do an ESOP with a company that's smaller than that, but there are some expenses from administrative standpoint, and you need to have, from the personnel standpoint, you need to have usually at least 20 people. But from a profitability standpoint, in order to offset some of the cost of just administering the plan that really isn't affected by how big the company is, you need to have about $250,000.
That's interesting. I've always heard $1 million for some reason.
Well, I mean, $1 million is helpful, certainly, but we found
more money the better, right?
Yeah, the bigger the deal, the more easily you're able to offset the cost. But we've seen a number of players do it, and we've done deals pretty efficiently, to allow that to work in a deal that's even $1 million, $1.5 million in size for the whole company. The business is worth $1 million, $1.5 million. So
let's take $1 million EBITDA example. So how does the valuation work? Because I think, as we, kind of put the bookend at the end of the episode, but like the valuation is is a financial buyer, right? Because you're talking about on the cash flow. So how does that work, versus like the sale that we did? We sold and there's strategic overlaps. And so you got a lot of cost cutting that you can do. So maybe just kind of talk through the valuation process, and then we can kind of just take this in chunks.
No, absolutely. So when you do an ESOP transaction, there really are two, very similar to sale to a third party. There's a negotiation. So you have the seller, and the seller is representing themselves, or they're having professionals represent them, but they're basically looking out for their own interest. And there's a trustee who oversees the ESOP that is looking out for its interest. And under ERISA, the trustee cannot pay more than fair market value. Fair market value, being defined as a willing buyer, willing seller, neither under compulsion to act in that case, which really is a financial buyer, because what they're buying is very similar to a private equity firm that doesn't have a strategic aspect that it's able to bring to the table. So you're really looking at the company's borrowing capability and the company's cash flows in order to see if they can pay off the buyout over time. That's very similar, again, to what an ESOP is looking at when it's valued. So it's not, when we're talking fair market value, we're looking at a price that probably is rather competitive in the market. But if you shopped a company in an M&A process, the ESOP isn't going to be the high bidder. It's probably going to be right in the middle of the mix of any of the financial buyers that are out there. So that really defines the pricing limitations of an ESOP, and the trustee is going to oversee that process.
Well, and then that's where we'll get into the tax savings, because the net proceeds might be more with the ESOP, even though the price might be more with the strategic. But then so we got the valuation, and then the trustee. I mean, like, I think people get really freaked out of this, Dave. It's like, well, there's someone else I no longer own my company, right? So this trustee, who is it? Where do they come from? You probably get that feedback a lot. So I don't know if you want to shed some light on that.
Sure. No, I mean, trustees, they can be, quite honestly, anyone. It's certainly not advisable that they be the seller, because, again, there's fiduciary responsibilities to being a trustee, and you don't want a conflict of interest. So, oftentimes, companies will have some of their employees be trustees, but that's really, there's a bit of a conflict in that situation. And so what's best, and what we recommend and really require for all of the parties that we represent, is that if they're going to do an ESOP transaction, that there be a third party qualified trustee that acts in that capacity. And these are institutional parties. It may be a small firm that happens to have an expertise in this, or it may be a large trust company. But we want to have people with actual expertise in overseeing the transaction. Once the transaction occurs, you will see some people, they will use the institutional trustee for the transaction. They'll put in someone, whether it be an independent party or someone working at the company that's independent in that capacity, just for administrative purposes. But most companies will continue on with their institutional trustee relationship. And really, that relationship is very passive. Right. So as you mentioned, if there's one thing that really spooks people when they sell to an ESOP, is that they're giving up control. And so technically, if an ESOP buys 100% or more than 50% of the company, they're going to want to have, control of the company, in fact. So, they're going to want to make sure that, they have the potential to legally do all that they need to do to protect their economic interest.
Yep.
Now, that spooks people, and they have the ability to basically place the board and elect the board members for the company, which should raise some concern to people from a conceptual standpoint. From a practical standpoint, though, the trustee has just bought into the company. It's bought into the management team of the company, to its leadership, and it wants to keep in place people that really have a sound understanding of the business. So it would be beyond rare to see someone who's a prior owner that's desiring to be on the board, or to have anyone at the company level that was associated with the board or leadership, to ever really feel any pressure from the trustee to act unless there's some severe problems. So the trustee has a lot more risk in trying to dictate how the business is run than in going through procedurally and making sure that they have good people in place, that they understand the decision-making process, and that the decision-making process is sound.
Right. And at the end of the day, it's not going to be some random stranger. I mean, you're going to be able to sit down and say, okay, like, it might be me, on the board, right? It might be me, my CFO, and a trustee, right?
And the trustee will never sit on the board, but the trustee will likely want some independent party to sit on the board.
Got it. Okay.
So they're what they want to do, like, we just closed a deal about 20 minutes ago. Part of the terms of the transaction were that the company who has a 5-person board was going to add 2 independent parties to that board. So the trustee won't even, they won't make a determination of who those parties should be. I mean, they'll want to review that and make sure that they're qualified, but basically the slate of potential board members is going to be proposed to them by the existing board members, and then they will approve. So yeah, you're right. No one's going to have someone shoved on their board that's going to become disruptive and whatnot. Mm-hmm. They really want the status quo to continue, and to make sure that the company's making good decisions and is proceeding along the path that was intended. So again, while giving up control is kind of real, from a practical standpoint, if the company is operating well and if people are making good strategic decisions, nothing's going to change.
Right.
I mean,
yeah. If you're running a sound company, you're being prudent already, then it's literally just going to be just the same. And
yeah. I mean, out of the 400 deals that we've done since I've been here, I think we've had 2 board members displaced, one who was disruptive and one who committed fraud. So
there you go.
Those are scenarios that are pretty extreme, and the disruption was pretty extreme too. So, those are cases where anyone would make the decision, but it kind of needs to get to that level for action to take place usually.
So then let's say let's even continue down that the kind of the path, because I think for the listeners that are contemplating this stuff, it's like, okay, well, you have your money too. So it's not like you just did this without getting any money or any terms, right? So let's say we're going back to the $1 million in EBITDA, and there's probably a range based on the financial buyer. And I think very specific, the biggest variable would be company specific risk and how well it's run, right? And making sure you can figure out what the valuation is. So, and then explain, when you said that you could either go get money from the bank or there could be seller financing, what does the kind of the fund flow look like for the seller? What are the different options and how does that work? Because, you're not going to go through the whole situation that you just described unless you got paid out, right? You're not just doing this for the heck of it. So like maybe kind of explain how that works.
Sure. No. So, in this path, let's use the $1 million example and say that it's a $5 million valuation. So 5 times EBITDA company in this case. Probably the most common structure that you'll see is a company like that will be able to go and borrow about 50% of their capital structure. So they'll be able to borrow $2.5 million of cash from the bank, and then they'll lend in themselves, as from a seller financing standpoint, the other $2.5 million into the transaction. So, they get liquidity immediately, and then they've got a note that's owed to them by the company that is subordinate to the bank, but is also receiving subordinated type returns that they'll end up carrying for a period of time. And so, for a lot of people, particularly after they sell a business, a lot continue to stay on. So a lot of people that we talk to about ESOPs, they're 5 or 6 years away from departing the company anyway. So they think, hey, I'll sell my stock. I'll stick with the company through, the end payment of my note, which I would say on average, most 100% ESOPs will pay out within about 5 years. They'll get the internal or the the seller notes paid
So
off.
it'll be done in 5 years usually after. So the bank and just kind of make sure that I want to reiterate for the listeners. So out of $5 million, some, half bank, half seller's notes, all of that's paid down in 5 years.
Yeah, I mean, and again, I'm thinking about a 5 times EBITDA deal.
Yeah,
But
yeah.
So,
Okay.
so the bank is basically paid off within 5 years, which means that you have
Got it. Okay.
availability
Got it.
of $2.5 million again to refinance out the seller. I will say that, one item that comes up often with people is they're like, well, it'd be great to sell my business to an ESOP, but again, I can get strategic value and I'm going to get more money there and whatnot. That can be the case. I mean, there certainly are scenarios where strategics can pay a lot more and will pay a lot more. But from an ESOP perspective, the interesting part is kind of twofold. One, an ESOP buys stock rather than assets. So there is some tax advantage to the seller at the time of the deal. And in fact, with an ESOP, and I won't go into the specific characteristics, but there is something called a 1042 account, which means that you actually have the ability to defer capital gains in what's very similar to a like-kind real estate exchange. So you're able to move your proceeds into a basket of qualified U.S. Stocks and bonds and move your basis over. So you're able to defer capital gains. And for those who are advanced in age and maybe looking at estate planning and whatnot, if you hold that in your estate until death, then there's a forgiveness of capital gains. So there's a clear planning and tax advantage in that scenario that plays out.
Can I put some color on that? And then I want you to continue. But because I was in my last episode, I was talking to an M&A attorney and we were talking about the asset versus stock. And so, I mean, literally difference between ordinary income and then capital gains, right? And then so on that let's say it was my company and I got 2.5 in cash, right? Or like that, like you just described, I can move that over, right? So just maybe versus if I sold to a third party and that was an asset sale, I mean, you're talking big numbers over the course of the entire.
Absolutely. And it's really important to look at the tax ramifications, because a lot of people look at the headline number, right? They want to go to the country club, pound their chest and say, hey, I got 7 million for my company rather than 5. And while it feels good, what goes in the pocket and what goes in the bank account is all that really matters. And so it's important to drill down and to understand the tax ramifications. So this 1042 exchange is pretty unique to ESOPs and is a real advantage. But the interesting thing too is that one of the other real advantages, and particularly right now, is that when we see people that are looking at retiring, or maybe they're not retiring, but they're selling their business, they're about to lose, likely if they're walking away and they are retiring, they're going to lose their income stream. And so they're looking to replicate some of that. And one of the biggest problems right now is that, CDs and bonds have a whole lot of risk to them and have very limited yield, and CDs have very limited yield. So it's hard for people to create some sort of a fixed income portfolio. When people do these deals, like I say, you get, in this case, $2.5 million worth of cash. That's a great thing to invest in equities. If you're going to have a balanced portfolio, you say, well, I'm going to invest half in equities, half in bonds. Well, the seller notes that you have within the company really are like a bond. But what they're going to do is, you're going to basically have a much higher interest rate, because there's a subordinated interest rate associated with these notes. And because of installment tax treatment on the notes, you're going to owe tax on the 2.5 if you take it out and don't do the 1042. The money that you receive, you're going to owe tax on capital gains rates. The other money that hasn't been paid to you yet, is tax deferred. So you're not earning a yield on the post-tax balance. You're earning the yield on the pre-tax balance, which even enhances that return even more. So, in every case but an ESOP, I would tell you that holding seller financing after a transaction is a massive mistake. In an ESOP structure, I think it's an incredible opportunity, and we see a whole lot of situations where we're having trouble, getting people to want to get their notes paid off than those who are looking to get the liquidity, just because there's no way to replicate it. And while people look at that too, and they say, here we have a situation where we've got all of this note. It's tied to one company. It's a company that person knows, and that person is actually gone and represented for sale at what it can do. And now that company, particularly if it's 100% S corporation ESOP, that company doesn't pay tax. So the risk return on those notes is phenomenal. In fact, if it wasn't a conflict of interest, I'd try and buy into every single deal that we have.
No kidding, right? Yeah, right. Well, and like, and even to put even more on top of that, because like I'm just thinking about my example from our sale. Like incomes, mine and my dad's incomes both go away. We pay astronomical amounts of taxes, and then we have to go find a way to replicate that income. And so, like, let's say go back to the example. I get 2.5 in cash. I put it over into like kind exchange, and then we got seller financing that is a yield that is on pre-tax. But then also, I get to keep my job, right? Like I also get a payroll, or I'm on the payroll.
Yep, and you get some of that stock back if you're staying with the company and it's a S corporation ESOP. If you do take the tax deferral and you stay with the company, you can't participate in the ESOP. But if you don't take the tax deferral, the 1042 that I was talking
Okay.
about, you actually can participate in the ESOP. So you're getting some of that stock back and again beefing up your retirement plan.
So then let's go back to like, okay, how does the actual ESOP distribute the shares? And so what is the average term of the ESOP? And then how do employees get in? Kind of the whole. You probably know which route I'm going with this. You can start however you want.
Sure. So we talked about how the seller gets his money. The day after this deal is done, so this $5 million deal that we've been talking about, right after it's effectuated, you have an ESOP that owns $5 million worth of stock, and you have a loan that it has back to the company of $5 million. What happens is, and usually this is set up, the term of that internal loan is set up in order to provide a certain level of benefits to employees. So, people, when shares are released, individuals within the company will receive stock based on their prorated portion of the W-2. So if I'm, if I'm being paid $100,000 in a company with $10 million of qualified payroll, I'm getting 1% of the allocation. So, what happens here is the company will basically say, okay, well, we're going to, in the case of the 5 million, say it's a 10-year loan, the company would make a $500,000 contribution to the ESOP so that the ESOP can pay off its note. Well, the note is actually owed back to the company. So the ESOP basically takes that money and sends it right back to the company to repay its note. So it's the release of the pay down of the note is a non-cash event for the company itself. But what that does is now they've paid off 1/10 of the loan. Now 1/10 of the stock that was in that plan is going to be released and allocated to participants based on their W-2 compensation.
So then, like, let's take that example, and if I'm the $100,000 salaried employee, I get 1% of the company. I stay with the company for, as this sequentially happens over time. I slowly get more and more, and kind of explain just because in real terms, employees come and go. Then you've got key executives. So how does the whole ebb and flow and the dynamics of the real world get impacted in that situation?
Sure. Well, I mean, obviously your leaders of your organization are your highest paid, so they're going to proportionally get larger because of their W-2. They're going to get larger allocations. But let's say that there's that $100,000 person. Yeah, the first year in that $500,000 example of repaying the loan, they're going to receive $5,000 worth of stock. So that stock's in their account. Now, ideally, that stock is going to increase in value over the course of time. So the next year, maybe the company is worth $600,000. So the next year, not only are they getting now $6,000 worth of stock in their account, but their $5,000 that they had before is now worth $6,000. So now you've got $12,000. And each year that releases, most of these programs, in order to deal with the turnover issue, they actually put in investing requirements. So they want to make sure that this is something that benefits people, who are providing for the company over the long term. So, for a lot of companies, they'll have normal compensation. A lot of companies will have year-end bonuses, and year-end bonuses are really about the near term. Mm-hmm. And ESOP, you're not paid out on the ESOP until you leave the company. You either retire or you terminate with the company. And if you're vested when that occurs, the company has an obligation to buy back your stock. So if I've been with the company for 7 years and I'm fully vested and I decide to retire and I've got an $80,000 balance in my ESOP account, the company will redeem my stock for $80,000, and that's how I get my liquidity.
Does it have to always be paid? Because I've heard like you can either do you can pay it out right away, or there can be kind of like a ladder depending on different situations. Can you get creative on that? Because I think one of the biggest things that a lot of people hear that and they get freaked out because they probably, depending on everybody's the spectrum of financial maturity of these companies, having all these liabilities on their books probably scares the living crap out of them. So
Sure.
like,
No. It's a great point. And the reality is there, because it's an ERISA protected plan, there are very hard lines that cannot be crossed. However, there's a whole lot of flexibility within those lines. And so there's a lot of malleability to how you go about structuring this. So you're right. I mean, you can wait if someone leaves the company, you can wait 5 years to buy them out and then buy them out over 5 years. That's the ultimate limit to doing this. So, anything short of that is acceptable. So there is flexibility there. Certainly for a lot of companies, if they're not done paying for the stock yet, they're not going to make distributions unless it's maybe death, disability, or retirement. They're not going to actually buy people's stock.
mm-hmm.
But there are a lot of safeguards there. And to your point too about liabilities, people are looking and saying, well, that's a big liability. I will tell you that in most cases, I mean, particularly for any healthy company, that doesn't have if it's in software and it has a massive multiple or something, it can change things. But for I would say 80 to 90% of the companies, particularly if you're 100% S corporation ESOP, you're no longer paying tax. So once this debt is paid down, a lot of these companies are building cash rather rapidly because they don't even they don't have enough things to invest in to use all the cash they're producing, and there's no one going to call for it. So the biggest demand for those companies ends up being repurchase obligation. But for most of these companies, if they have a normal 7 to 8% turnover within their population that's vested, so that's not annual. So you might have a company that has a lot of turnover any given year for the first year employees or whatnot. But for people that stick it through, anything from 7 to 10% is a pretty normal number. The tax savings alone from the structure helps to finance all of the repurchase obligation, and companies are able to operate, very cleanly through that and navigate those waters rather clearly without any real issues.
Well, and then you make, and because you paid down $5 million in debt, I mean, already, so you have cash that's just accumulating. So, and I think also just a note is that you have people like you and these other people that are sitting on your side that are helping you with the forecasting and the modeling of this stuff, right? So you're not just sitting there blind to just your own devices, right? I mean, you have people that are helping you, making sure that you can see clearly down the road. You know what I mean? So
Absolutely. I mean, it's critical, particularly with an ESOP, given how nuanced it is, to have a quality team and professional parties helping not only to structure it, but then to be a part of the ongoing administration. Because at the end of the day, what's required. So if I'm a participant, the only thing that's required for me to receive every year is that every year the business has to be valued, so that you know how much the stock is worth. And you need to know what the allocation is that year. But what a participant actually receives is simply a statement that says how many shares they own and what those shares are worth and how much they're vested. That's the only information that someone has to be provided. So there's not any real detailed information sharing, whatnot. Now, there's a lot of companies, and obviously you were talking, as you mentioned, to Jack Stack. I mean, there's a lot of parties that are ESOP companies that practice open book management. There's a lot of great game players that are out there in the ESOP space. So they share a lot more information, and they use the ESOP alongside some of Jack's strategies to go and engage their employees. But at the end of the day, if that's not what you want, you have the ability to do that. You also have the ability, when structuring this, to extend the front end of the loan to kind of allocate the stock over a longer period of time. So it's not unusual for this internal loan to allocate, say you do a 100% transaction, to allocate the stock over 20 years if that's hitting your target benefit that you're trying to provide to employees. So that repurchase issue in that case really isn't going to raise its head at the very earliest until 20, 25 years out. And really, if you're managing the business well, it really will never impact you.
Well, and you make such a huge point, and I want everybody to constantly hear that, because you don't all of a sudden have a socialist, company where everybody's got to vote and you've got to, go. I mean, I can't tell you how many times I've heard that. Well, I'm going to have to answer to 150 of my employees and blah, blah, blah. It's just like, that's not the case, right? I mean, because correct me if I'm wrong, but because the ESOP owns it, it's not like you have all these minority shareholders that you have a prudent responsibility to disclose this stuff with, right? Because of how the whole structure works.
Yeah, exactly. I mean, again, all you have to disclose to them is exactly what I told you. I mean, that's the only information they need from that standpoint. I mean, I own Apple stock, and I can't tell Tim Cook what to do. It's no different, right? I mean, yeah. and Tim Cook doesn't own Apple. Tim Cook's an employee, and that's really an ESOP is extremely similar from a governance standpoint to a publicly traded security, because you have a board of directors that oversees management, which oversees rank and file, and they provide their services to a very broad-based ownership group. An ESOP is kind of the same, but it's the employees of that given entity.
Well, and let's talk about like how the dynamics can change if the things go right as far as like culture. And so we talked about this, the tax savings, right? So obviously financially there's a huge benefit, but let's talk about like what culturally and legacy, because I think, Dave, you and I and Jack Stack and like Bo Burlingham, all these people that really understand that a lot of these founders, they want their legacy to carry on, and they want their employee, like, so like explain kind of the dynamic shift that happens and how that works, and what happens with the culture. Because and to kind of put a bow on that, I interviewed, do you know Daniel Goldstein at all from Cedar
Yes.
Rapids? Yeah,
Yes.
so I interviewed him on the show, and 134-year-old company, ESOP, and he said, and that's what I titled the podcast, using the purest form of capitalism, because people invest their labor, right? And then they actually become more wealthy. And Jack said that he's got a guy on the shop floor that's making $15 an hour that's a millionaire. And
Yeah.
so can you just kind of explain the employee mindset, how that happens, and what happens with the culture and the competitiveness, compared to other people and other companies?
Sure. I mean, I think the main thing, one is that, it's your point, kind of in the front end of that is what it sometimes means to the seller. I mean, almost every seller, it's very rare to find a seller where dollars are the singular most important thing in a sale process. They may start the process that way, but it's critical to evaluate what's truly important to them in the process. And oftentimes, it's their employees, it's the legacy of the business, it's the legacy to the community. I mean, for businesses, we had a business that was in rural Kansas that, I mean, the company actually employed half of the community.
Yeah.
And the company was potentially up for sale. They were trying to decide whether to do an ESOP or to sell it outright. If they were sold outright, the business was going to be uprooted and moved to another facility and combined with that, and the entire town would have shut down. That's not the legacy that party wanted to leave behind. That's a pretty extreme example, but that's something that so I think that's something that a lot of people kind of deal with, and on a much smaller scale than that. So for a lot, it is an emotional aspect. They're saying, well, I don't want my biggest competitor to buy us and to be running this. I don't want a private equity firm to buy us and to have these managers who've helped me to grow the business now having to answer to someone else and go through that process. They like the idea often of independence, and with that, you often can drive both operating improvement and heightened retention through having an ESOP program. So ESOPs work fantastically in service businesses. So Prairie Capital is actually an ESOP owned company. So our assets walk in and out the door every day. It's all human capital related. We consult. We have a lot of people with a lot of expertise who do a phenomenal job, but we want to help them to have some skin in the game and to have a stake in our equity performance on any given year. So we put in place an ESOP, and what that does is it really provides a benefit that not many companies can, because oftentimes ESOP-owned companies, in almost every scenario that we see, actually provide benefits at a higher level than others. So there's enhanced retirement benefits at most of these companies, and this is something where again they can find their tie into the equity of the business, which makes for a different cultural dynamic. I mean, and that cultural dynamic doesn't necessarily just happen simply because somebody owns stock. But most ESOP companies really work with their employee base to help to build an employee-owned culture, to help people to embrace the fact that they are planning on remaining independent, and that they are getting a piece of the action going forward, and what they can do to help to improve that, and it helps them to hold one another somewhat accountable. So we see all sorts of companies that do a phenomenal job of building that culture and helping to expand the business, save on from a cost standpoint, and really lower the turnover that may be inherent in their industry.
Well, I think it's so interesting, Dave, because I mean, first of all, there's probably got to be an inherent like kind of profile of the sellers, like, and the cultures that gravitate towards this versus like the dictatorship stuff that might be right. Like,
Yeah.
this has been in my personal piggy bank for boats and cars, and everybody's just worker bees. But like, so there's probably a generic or a general like difference of those kind of people. But I just think like if you think about this is just my own 2 cents, but like it's kind of like common sense and human nature. Like we all want to be like we all want affirmation. We all want to be a part of something as human beings, and then we all want to be driving towards a goal together. And then like when you wrap together that everybody becomes wealthy doing that, like it kind of just naturally makes sense that everybody is going to pick up the phone one more time, or like customer service. I just think about like someone that's making $14 an hour who has problems at home, fighting for retirement, doing all this stuff, and then next thing you know, they know that there's a bigger carrot at the end of that. Like you're gonna just be different as a normal person. I just makes too much sense.
Absolutely. But it does take, I mean, it takes some effort and some skill. But if you get a company that's built like that, it is amazing to see, the emotion that pours out of people as it relates to this. I mean, when you have people retiring, and we've seen plenty of them that, retire, some of them with a 7-figure account that weren't even in jobs that were, more than $100,000 in pay. It's like they could never do that otherwise. And so there is potential in it, and ideally if the company's operated well, and again, they have that cultural build, then it can happen. I mean, even if someone has and received this, a much smaller amount than that, it's still something that's saved for retirement that they didn't have to reach into their own pocket to help to do
Mhm.
that.
Yeah, or save after tax or something like that. What are some of the, because I know we're getting short here on time. One very specific question: can ESOPs be sold?
They can, and in fact, we're selling an ESOP tomorrow.
Oh.
So, uh, they can be sold, and we see a few of those sold. So out of the 300 that we actually have that we work with annually, we usually have about 5 or 6 every year that are sold, and for a lot of different reasons. Sometimes for strategic reasons. Sometimes technology has moved in a way that's made them less efficient. Maybe there's consolidation within an industry. The trustee and the management team really has an obligation to look out for the shareholder. And if there's a good time to monetize and that makes sense, then you'll tend to see companies do that. Now, most companies, if they want to remain an ESOP, are going to find ways to to build in the succession and to ensure that they're able to stay independent and whatnot, which is great. But if there is a need to sell, or in some cases, if there's just simply an opportunity that's too good to pass up financially, you'll see companies do that. So there may be cases where someone comes knocking on the door and absolutely positively strategically needs that party, and everyone's net worth will go up 3-4-fold and overnight. So it all depends.
So, if I'm an owner and I'm sitting there going, okay, what's the, that sounds awesome. But then I've also got, I see it all the time, Dave. Like, we knew our industry like super well, right? Like there's always this, I think there's this creative gravitation towards owners going, well, if you put this person with that person and that person buys this person, then you can do all this stuff versus like an ESOP, like there's kind of like a creative, a shiny object to selling to a third party of the people that what would be like the couple questions that you'd leave people with as they're kind of looking at the different options and how they might impact different things, or kind of what I was just describing?
Yeah, I mean, I think it's one tool in the case. And so as we started out this program and we were talking about the process that we go through, I think it's just critical for people to sit back and evaluate all the alternatives and see how they affect them and how they affect the things that are important to them. It's a great tool. It certainly is a tool that allows for continuity of the management team to continue on, for legacy to continue to move on, and even as importantly for a lot of people, because this is an internal ownership transition, it's far more controllable. I mean, there is kind of a go and no go number. Whereas if you went through, I mean, when you're marketing to third parties, there's a whole lot of noise that's out there that you need to deal with, and there's a whole lot of emotion that shifts back and forth throughout that process that has a lot less of a foundation than going down an ESOP path. So
Way more unknowns. Oh my gosh.
And putting in an ESOP deal takes about half the time as it does, to sell to a third party, maybe less. But It's a good alternative to consider. It's not right for everyone, but I will tell you that the community itself, of those that are, employee owners of ESOP companies and those that have sold to an ESOP, you'll see and hear a lot of people that are cheerleaders for the structure and the concept. And quite honestly, right now, it couldn't be more straight down center with regards to the narrative in the country surrounding, wealth inequality. I mean, this is a case where you're taking what's in the hands often of one or two people and putting it in the hands of thousands. And also, that our country is a shortage of retirement savings, and this is a program, that helps that, and it keeps jobs in America and in their communities. So there's a lot of really positive messages that come out of this. That
and it's not like the owner has to give up half his wealth to do it either. You know what I mean? And
you're getting paid.
Right, you're getting paid to do it all.
and in a lot of cases, we talked about. I mean, if you're looking at certain situations, you may be getting paid a lot more on an after-tax basis than you would otherwise, depending on how it's structured and how the business performs.
I love it. I know you and I could keep going, and I want to be respectful of your time. So the people that want to learn more, hear more, where do they find you and the company and the website, all that stuff?
Sure. So, you can come to any of our 8 offices. We'd love to have you there, but the easiest way to reach us is on www.prairiecap.com, 2 I's in prairie, because a lot of people do it. Misspell that, but yeah, prairiecap.com. You have all of our contact information there, but even more importantly, there's a whole lot of content from an educational perspective that you can draw upon. But we're happy to go out and meet and speak with anyone about ownership transition at any time. So know that there's not a meter running. We're happy to spend time just on the education up front to help people understand our services and what this process is all about.
Dave, it's been a blast. Thanks so much for coming on. I had fun.
No, appreciate it, Ryan.